Welcome to this ICMA briefing, which is in 4 parts. First, I'm going to give an overview of the global transition from Libor to risk-free rates, particularly in the international bond market. Then Katie Kelly is going to speak about the adoption of risk-free rates and the active transition of legacy Libor bonds. Charlotte Bellamy is going to speak about legislation on tough legacy contracts. And Mushtaq Kapasi is going to speak about the transition in Asia Pacific. We estimate that the briefing will last around half an hour. The international financial markets need to be ready by the end of 2021 for the cessation of Libor on or after that date. As Libor has for many years been embedded in the international financial system, the transition away from Libor is a global initiative. The authorities globally consider that the transition away from Libor is an essential task and a priority for the G20. They want financial markets to transition away from Libor to near risk-free rates. SOFR in US dollars, SONIA in sterling, ESTA in euro, Saron in Swiss francs, and TONA in Japanese yen. The changeover from Libor to risk-free rates is being coordinated globally by the Financial Stability Board Official Sector Steering Group, which is chaired jointly by Andrew Bailey, Governor of the Bank of England, and John Williams, President of the Federal Reserve Bank of New York. They are supported by risk-free rate working groups involving the authorities and market participants working together at a national level. ICMA is participating in the Sterling Working Group on risk-free rates and chairing the bond market subgroup. ICMA is also participating in the Euro risk-free rate working group as an observer and the Swiss National Working Group. And ICMA is in regular contact with the FRN Group Chair on the Alternative Reference Rate Committee in the US, the ARC, and with national working groups in Asia. The starting point for the transition is for market participants to use risk-free rates or another alternative rate instead of Libor in new financial transactions. Substantial progress has been made in using risk-free rates in wholesale markets internationally, including in the sterling and US dollar bond market and the derivatives market. Progress is now being made also in the loan market. In the sterling floating rate bond market, new issuance has been referencing SONIA, compounded in arrears, for some time, and new issuance referencing Libor has all but ceased. Risk-free rates compounded in arrears are the most robust rates. They are based on actual transactions rather than expert judgment. The market conventions being used for new transactions referencing risk-free rates compounded in arrears are broadly similar internationally, though there are marginal differences between products and within the same product. Despite good progress in the transition to risk-free rates in new transactions, there is a stock of outstanding legacy transactions still referencing Libor. Many of these mature beyond the end of 2021. The authorities have encouraged the market to reduce the legacy stock to an irreducible core through active transition from Libor to risk-free rates before the end of 2021, or to introduce fallbacks from Libor to risk-free rates where this is practicable. As risk-free rates are economically not the same as Libor, a credit adjustment spread needs to be added. In the UK, active transition from Libor to risk-free rates in the bond market needs to be carried out bond by bond. A multilateral protocol, like ISDAs in the derivatives market, is not feasible in the bond market. Most legacy Libor bonds were issued before July 2017 and when LIBOR ceases, will fall back to a fixed rate for the remaining life of the bond. Some bond contracts are too difficult to transition. There are also too many to transition by the end of 2021 at the current rate, though potential ways of speeding up the transition process are being examined. As a result, there will be an irreducible core of tough legacy contracts referencing LIBOR outstanding in the bond market at the end of 2021. The UK authorities are proposing to legislate for tough legacy contracts. In response to the FCA's international role as the regulator of the administrator of LIBOR, UK legislation was introduced on the 21st of October to ensure an orderly wind down of LIBOR. The legislation will grant the FCA new powers to direct the administrator of LIBOR to change the method of calculating LIBOR from a panel of banks to a different method called synthetic LIBOR, when LIBOR is judged to be no longer representative of its underlying market on or after the end of 2021. At that point, pre-cessation, the FCA will have the power to prohibit the use of LIBOR by supervised entities in new transactions, but to continue to permit its use in certain legacy transactions. The FCA has been consulting the market on the use of its powers under the proposed legislation, and the administrator of LIBOR, the IBA, has been consulting the market on its intention that the euro, sterling, Swiss franc, and Japanese yen LIBOR panels should, subject to confirmation following the consultation, cease at the end of 2021, while 1 week and 2 month US dollar LIBOR would also cease at the end of 2021, and the US dollar panel would cease at the end of June 2023. The proposals for US dollar LIBOR were accompanied by a statement on the 30th of November by the Federal Reserve and other US authorities. They are intended to give a clear message to the market that LIBOR should not be used for new transactions after the end of 2021. They also establish a potential mechanism that can help support the roll-off of a substantial portion of LIBOR-linked legacy contracts. That will help to focus on the remaining legacy exposures that will extend past the mid-2023 date, and especially the tough legacy contracts that after mid-2023 will not have an effective means of transitioning away from LIBOR when it ends. Whereas the legislation in the UK will give the FCA extra powers to change the method of calculating LIBOR for certain legacy transactions, draft legislative proposals by the ARC in the US use contractual overrides in order to transition contracts from LIBOR to risk-free rates plus a credit adjustment spread. These different approaches may achieve the same result, though that is not yet clear. In the EU, the benchmarks regulation is also being amended to include provisions catering for an orderly wind down of benchmarks, such as LIBOR. Unlike LIBOR, Euribor will continue for the time being, though EONIA is being replaced by ESTA and more robust fallbacks are being built into new Euribor contracts. The introduction of legislation in the UK to increase the FCA's powers to ensure an orderly wind down of legacy LIBOR contracts is welcome. But there are a number of practical questions which remain to be clarified about how best to make the proposal work, particularly in the bond market, and about alignment between the proposals for legislation in the UK, the US, and the EU. Finally, on the 16th of October, the Financial Stability Board published a global roadmap of the preparations needed by firms to transition away from LIBOR, and noted that individual regulators may require firms to move faster in some instances. The key steps in the roadmap are set out in ICMA's quarterly report for the first quarter on the ICMA website. I'm now going to hand over to Katie Kelly.
Thank you, Paul. So in the bond market, as Paul alluded to, new public issuances of Libor have pretty much ceased, and there have been around 170 FRNs linked to SONIA since 2018, and at least 50 securitizations, equating to almost 100 billion sterling. The first half of 2020 was particularly busy in the SONIA market, but there wasn't so much issuance in the second half of the year. There's nothing sinister in that. Funding programs were completed early. Other priorities rose to the surface during the COVID-19 crisis. Interest rates were low, and the floating rate market is not really a corporate issuer market, so corporate issuers were absent. On the other hand, the range of issuers and investors who have been able to issue and participate in SONIA-linked transactions has been increasing all the time. In the US, SOFR-linked issuance has been very healthy, mainly among the agency issuers. Approximately $890 billion notional in floating rate instruments linked to SOFR have been issued as at the end of December 2020. Euro STR uptake has been less healthy, totaling almost 5 billion over 7 issues. Alignment in terms of conventions internationally has been an ambition. It would make it easier for issuers who are issuing cross-product and cross-currency, and it would facilitate systems build, but it hasn't quite been achieved. There are some differences between the conventions, as between, for instance, SOFR in the dollar market and SONIA in the sterling market, as well as between bonds and loans, although there has been alignment between derivatives and bonds. As far as we understand it, the US market hasn't yet coalesced on one particular set of conventions, although the ARC, which is the official sector-sponsored working group looking at US dollar Libor transition, has suggested conventions for a number of different products. As for the sterling bond market, there may end up being 2 different sets of conventions. The overwhelming majority of FRN and securitization issuance has been using the observation lag approach to weighting, which means that each SONIA rate is weighted according to the number of days that apply in the interest period. And this is compatible with the use of the long-form formula for calculating compounded interest. The Bank of England has started to publish daily compounded rates in a SONIA index, which lends itself to the use of the observation shift approach to weighting, which weights each SONIA rate according to the number of days that apply in the reference period, which is different to the interest period. The use of the SONIA index, and therefore the shift approach, has only been used in a handful of FRNs, but this is more because there hasn't been much issuance generally, and it's expected that future uptake of the SONIA index will increase. We understand that a lot of issuers are incorporating the flexibility to issue either using the lag approach or the shift approach. So it seems likely that both the lag and the shift approach will continue to coexist. And in terms of economics, there's practically no difference between the lag and the shift approach, but it is important to know that whichever one is being used is easily identifiable. Just a word about term SONIA. Term rate providers are now starting to remove the beta tags, but we would stress that term rates should be limited to appropriate use cases so that systemic risk doesn't build up. Elsewhere in the US, the Fed has also started publishing a SOFR index, which has been used by some domestic and international issuers, and will be working in the first half of 2021 on developing a term rate. As for Euro STR, a consultation was released on a Euro STR index in 2020, and feedback received was overall quite positive. This feedback will be useful for the ECB to finalize the methodology of any proposed index, and a Euro STR term rate may also be developed. When it comes to legacy, as Paul said, there's a stock of outstanding sterling transactions still referencing Libor, many of which will mature beyond the end of 2021. Most of them will have some kind of fallback for the discontinuation of Libor, and we tend to bucket those fallbacks into 3 types for convenience only. I'll come back to the type 1 fallbacks in a minute, but the type 2 fallbacks generally feature in bonds issued from mid-2017 up to around about the start of 2019, and fall back to a successor rate plus a credit adjustment spread on the permanent cessation of Libor. Type 3 fallbacks are typically found in bonds issued from 2019 and beyond, and fall back to a successor rate plus credit adjustment spread on a statement of the non-representativeness or permanent cessation of Libor. I'd just like to take this opportunity to highlight a consultation which was recently released by the RFR Working Group on what the successor rate should be, either SONIA compounded in arrear, or term SONIA, or something else. The credit adjustment spread has previously been consulted upon and will be the ISDA historical 5-year median. Together, these two elements, once fully consulted upon, should allow the Type 2 and Type 3 fallbacks to operate in accordance with their terms. Type 1 fallbacks will ultimately fall back to the last Libor fix, and it's these transactions that the authorities want reduced to the irreducible core through active transition. So far in the bond market, about 40 consent solicitations have been undertaken successfully, but there are many, many more to do. And as Paul said, potential ways of speeding up the transition process are being examined. But there may be other reasons why consent solicitation isn't happening at the required pace. Maybe in 2020, COVID-19 had effect on priorities. Maybe there's too much uncertainty about the outcome. Quorum and voting thresholds in consent solicitations are high, and there's no guaranteed outcome. And in fact, a few consent solicitations have recently not been successful. It can be hard to identify all the investors and ensure their engagement. And consent solicitations can be costly, time-consuming, and potentially complex, which can be off-putting. Some transactions may be too difficult to amend, such as securitizations, where parties may be absent, and there may be complexities in the structure itself. And fundamentally, there are simply too many to do in the time left. But the message from the authorities couldn't be clearer. Actively transition now and do not wait for a legislative solution. In doing so, parties can control the economic outcome and will also have the ability to align with any hedging instruments, which will fall back to SONIA compounded in arrear, in line with the ISDA protocol. Otherwise, those particular hedging instruments would have to be excluded from the ISDA protocol. It remains the case that consent solicitations under New York law are much more challenging than under English law, with higher consent thresholds to be achieved and a much bigger pool of affected transactions in the first place, which may require a different solution. I think this naturally segues into looking at the tough legacy solution, so I'm going to hand over to Charlotte Bellamy to continue.
Thank you, Katie. So as you say, this does lead naturally into a consideration of the legislative solutions that have been put forward by the official sector to deal with the question of what some people call tough legacy. And this really recognises the challenges associated with active transition that you just mentioned. As Paul mentioned earlier, there are now 3 legislative proposals in different jurisdictions, namely the UK, the US, or more precisely New York, and the EU. To set the scene for these, it's worth recapping briefly on what we know already about how the endgame for different Libor currency tenor pairings is likely to play out. So as Paul mentioned, the administrator for Libor, IBA, has consulted upon its intention to cease the publication of all sterling, euro, Swiss franc, Japanese yen, and the 1-week and 2-month US dollar Libor settings from the 31st of December 2021, and the remaining US dollar Libor settings from the end of June 2023. So this means that Libor cessation is progressing on different timelines for different currencies, with the most commonly used US dollar Libor settings likely to continue, at least in their current form, for longer than the other currency settings. However, it's worth emphasizing again that the continuation of US dollar Libor beyond the end of 2021 and up until the end of June 2023 is intended to support legacy contracts only. The US authorities have indicated that the use of US dollar LIBOR in new contracts should be phased out as soon as practicable, and in any event by the end of 2021. And the FCA has similarly indicated that it will consider how to limit the use of US dollar LIBOR in new contracts. So turning now to one of the tough legacy legislative initiatives, IBA stated that its proposals for LIBOR cessation are subject to any rights of the FCA to compel IBA to continue publication. This refers to the powers that the FCA, as supervisor of IBA, is expected to have under the UK benchmarks regulation to compel IBA to publish what some market participants call synthetic LIBOR. The introduction of these FCA powers is currently being considered as part of the UK Financial Services Bill. And the idea behind synthetic LIBOR is that it would support an orderly transition because there would be a rate published on the same screen on which LIBOR is currently published, but based on a modified or synthetic methodology. This rate could be used for the purposes of tough legacy contracts, which the FCA describes as those contracts that cannot practicably be transitioned away from the benchmark by agreement among the parties. More clarity on precisely what this means is expected to emerge during the course of this year, and this will be very important for the bond market. The FCA has already conducted 2 consultations related to how it would intend to use its powers under the UK Financial Services Bill, and it has published some information in this area. In particular, it has stated that it seems unlikely that it would be able to exercise its powers to compel IBA to publish a synthetic version of Euro and Swiss franc LIBOR, because it's unlikely that the conditions and inputs will be available when those rates are expected to cease. So that means that, subject to the results of IBA's consultation, we could expect Euro and Swiss franc LIBOR to cease at the end of 2021. But on the other hand, for sterling LIBOR, the FCA has indicated that it is considering the introduction of a synthetic sterling LIBOR, and that this would be on the basis of a term SONIA rate plus a fixed credit adjustment spread. In relation to US dollar LIBOR and yen LIBOR, the FCA has stated that it will continue to assess whether it would be necessary and feasible to use its proposed powers to support tough legacy contracts. To add to the mix of issues, legislative solutions have also been put forward in the US and the EU, as I mentioned before. So the US and EU proposals are different in nature to the UK proposal, in that they envisage a legislative override of certain contracts rather than a change to the benchmark at source. In the US, the legislative proposal was put forward by the ARC. It relates to US dollar LIBOR and is designed for New York law contracts, although the ARC supports similar legislation at a federal level in the US. Typical bonds would be expected to be in scope, and the override would be to a replacement rate and credit adjustment spread nominated or recommended by the ARC or another relevant body. In practice, what this means is that we would expect many New York law governed US dollar LIBOR bonds and other in-scope instruments to switch automatically to the recommended replacement rate and credit adjustment spread pursuant to the terms of the legislation. It's also worth mentioning that the proposal includes a legislative safe harbour concept, which is aimed at protecting relevant parties from litigation. In terms of process, it's not clear exactly when or how this might be implemented into New York state law, although it has recently been included in the New York State budget plan for fiscal year 2022, which is due to be agreed by the end of March this year. In the EU benchmarks regulation will be amended to include provisions that are similar in approach to the New York law proposals. And it was announced this week that these changes will be published in the EU's official journal on the 12th of February and apply from the following day. The way this legislation works is to give the European Commission the power to designate a replacement rate or rates, a credit adjustment spread, and various other elements that would apply to contracts on a statutory override basis. So this statutory override is stated to apply to contracts and financial instruments that are governed by the law of an EU member state, as well as contracts where all the parties are established in the EU and that are governed by a third country law that doesn't provide for an orderly wind down of the relevant benchmark. So overall, there's now quite a complex web of different legislative initiatives and different timeframes for the Libor endgame. This throws up lots of questions, not least in terms of how the different initiatives will interact with each other. For example, might they result in the same replacement rates and credit adjustment spreads being applied to legacy Libor bonds and other contracts from an economic perspective, even if the legal method of reaching that point differs? And there are related questions for the bond market, such as what will happen to rates based on Libor, such as the ICE swap rate, which is referenced in certain debt instruments. While the announcements by the authorities towards the end of last year were very helpful in outlining broadly how the Libor endgame might play out, it will be really important that further clarity emerges so that market participants can understand and anticipate what will happen and whether any legislative solution applies in any given scenario. And we at ICMA will, of course, continue to engage with our members and the authorities on these important questions. I'll stop there and hand over to Mushtaq.
Thank you, Charlotte. As with developments globally, authorities in Asia Pacific have consistently stated that the best way to minimize the risks associated with the transition from Libor to risk-free rates is to not issue new bonds linked to Libor or to other local benchmarks directly linked to Libor, and to actively transition any bonds that already link to Libor and will mature after Libor is discontinued in the relevant currency. However, new issuance linked to Libor has continued in the Asia-Pacific region. ICMA and Bloomberg have undertaken a preliminary analysis of the Asia-Pacific market to determine the scope of floating rate notes, FRNs, issued by Asian issuers linked to Libor, which will mature after the end of 2021. This analysis, using Bloomberg data, estimates that as of November 2020, there was an outstanding volume of US dollar 250 billion equivalent of such FRNs across almost 900 issuances. Note that this figure excludes government, municipal, SSA issuance, and securitizations. Some highlights of this analysis include the majority, 80% of this outstanding volume, has been issued by financial institutions, including banks and issuers. The remainder has been issued by non-financial corporates across various sectors. By country, defined as country of risk with respect to the ultimate debt obligor, Japan accounts for the largest share of issuance by volume, at almost 2/3. There is also significant issuance from China, Australia, and South Korea. In terms of number of issuances, Japan accounts for 47% of issuances, and China accounts for 18% of issuances. In terms of currency, Japanese yen and US dollar together make up almost all of the outstanding volume of Libor issuance, with each accounting for almost half. However, US dollar FRNs account for 70% of the total number of issuances, and Japanese yen account for approximately 27%. Now, with respect to US dollar FRNs only, if we look at the governing law, the majority of these, 53% of volume and 67% of issuances, are issued under English law, with the rest under New York law, Hong Kong law, or other governing laws. And finally, by maturity, while about 1/3 of the issuance maturing after 2021 will mature in 2022 or 2023, 30% will mature after 2028, and most of this is perpetual. Apart from the exposure to these tough legacy bonds, another important aspect of Libor transition in APAC stems from the fact that some Asian domestic benchmarks are linked to Libor. In particular, they are synthetic benchmarks derived by applying a forward FX curve to the USD LIBOR curve. So, when US dollar LIBOR is no longer available, the sustainability of these benchmarks is in doubt. These key benchmarks include SOR for Singapore, Thai baht fix for Thailand, MIFOR for India, and PHI REF FIREF for the Philippines. Some have replacement rates for new transactions identified and transition timelines in place, in particular SOR to SORA in Singapore and Thai baht fix to THOR in Thailand, whereas others are yet to identify the replacement rates. As a result, any organization or firm planning for the cessation of LIBOR should also consider its exposure to any of these domestic affected IBORs. For further information on LIBOR transition in Asia-Pacific jurisdictions, ICMA maintains an up-to-date webpage with links to official sector materials and other public information in respect of benchmark-related developments in Asia-Pacific markets. This covers Australia, China, Hong Kong, India, Japan, Singapore, South Korea, Taiwan, and Thailand so far. Please do contact us at apac@icmagroup.org if you have further questions. I will now hand back to Paul for final comments.
Thank you all for joining us for this ICMA briefing on the global transition from LIBOR to risk-free rates in the bond market. We will stay in contact through future briefings and the ICMA website. Thank you all, and goodbye for now.